Hello, I'm Alan Kohler, founder of Eureka Report, finance presenter on ABC News and a columnist for the New Daily.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.
And we are the Money Cafe. But we're not in the cafe because I'm in Sydney flogging my book.
Oh, right. How's it going?
It's all right. I mean, I did an event last night at the Royal Oak Hotel in Balmain. It was very nice.
Oh, yeah. Good pub, that one.
Oh, you know that, do you?
Oh, I've been there once or twice, yeah. Nice place.
It was good.
Excellent.
Yeah.
Excellent.
So,
and has everyone got a solution to the housing crisis for you?
Everyone's got a solution. That's true. Everyone in Australia, I think, has a solution to the housing crisis.
Are any of them right?
I think all of them are right. Every single one.
Okay. Very diplomatic.
Some more right than others, perhaps.
Yeah, fair enough.
But I just on the question of housing, I think we can now declare what the solution is actually going to be, and it is building high rise around train stations in suburbs.
Right.
That's what's going to happen.
That's just your sense from going to Sydney, or
no, that's the decision that governments have made.
Is that in as the person who literally wrote the book, is that a reasonable solution?
It's the cheapest one, in a way. I mean, the cheapest for governments. In my book, I concluded that probably won't, that sort of thing, densifying the suburbs probably won't work because nobody wants to do that. And Australians don't really want to live in apartments. So I kind of said in the book that what has to happen is a better transport infrastructure to open up regional areas for more housing so people can get to the city more easily. But that's not going to happen because no one can afford it. It's too expensive.
It's an interesting point, though. I mean, the AFR had a property summit start of September, a couple of weeks back now, and the view from developers in that was that the densification argument, the high rises around train stations, is sort of easy for governments to say, like, you know, it's a as you say, a quick and relatively inexpensive fix for them. But the problem at the moment is building an apartment building or an apartment that the average person can live in is impossible. Like the argument from the developers is those apartments are basically going to have to be for wealthy downsizers because there's no way. And the New South Wales Productivity Commission had some good numbers on this. There's just no way you can get one of these things out of the ground for much under $1 million.
Yeah. So that is exactly what the problem is. And what's occurring is that housing, because of the cost of building houses, housing is starting to become a luxury item, and not an affordable one. So I think you're right. There's a real problem. Yeah, I mean, and that would occur wherever you built the houses, whether it was on the road to Geelong or on the road to Bathurst or around the station. So it's kind of a real problem, and that's why I think the other solution has to be the Housing Australia Future Fund, which is designed to subsidise private investors to build affordable housing.
Yeah.
But it's not big enough. So, it's just the amount of money in there is peanuts compared to what's required. So unless the government does more to subsidise affordable housing, you're right that the apartments that get built are going to be too expensive.
Well, one of the things in that New South Wales Productivity Commission report was a suggestion that governments need to look at their own infrastructure needs, and you would have noticed there's plenty of infrastructure going on around Sydney, including their beautiful new metro. But the point was that governments need to sequence their infrastructure build so they're not crowding out housing construction. Again, probably easier said than done because infrastructure is a vote winner. But is there something in that as well?
Well, I guess so. That's part of the reason. It's part of the reason construction labour is hard to find, is because they're all building bridges and tunnels and stuff. But the thing is, we need those things too.
Yeah.
So I don't know. I think it's a terrible problem. I don't think negative gearing and capital gains tax will be changed. Doesn't that's not Anthony Albanese's taken that off the agenda. So having flown the kite, he flew the kite. Saw that it was going to fall to earth and reeled it in.
Yeah. It's been a strange week of debate on that, hasn't it?
That's right.
Or non-debate. So yeah.
Hey, moving on. You listened to Chris Mackay yesterday. What did you call him? Legendary investor.
Yes, I did call him a legendary investor.
Why is he legendary for a start?
Well, he's the co-founder of Magellan, which is, I guess one of the bigger fund management houses in Australia. And I think he's sort of well known for being sort of a bit of an iconoclastic value investor. So his listed investment company, MFF Capital Investments, had their annual general meeting yesterday. Mackay doesn't do a whole lot of talking in the media, but he gave a lengthy address, which is really interesting. I mean, you can just look up the MFF ticker, and you'll be able to read it. It's about 5,000 words long and covers everything in markets from everything in markets in the world, from how the cost of living pressures are hitting the next generations, to how governments are going to overspend and keep inflation high, to market returns are going to be lower over the next few years. So I just thought it was a bit of a tour de force of a.
So what did he sum up what he said?
Well, look, I guess what he said is this is a really difficult time to invest. You can't sit in cash because the value of that cash is being eroded by inflation, which is likely to remain high in his view. So you've got to make a choice. Where do you go? His view is at the moment, too many people are getting stuck in passive investing that, basically moves up and down on on noise in the market, and they're chasing short-term yield and momentum and not doing the fundamental analysis that investors have been doing since Benjamin Graham wrote The Intelligent Investor. And he says that the good news is that the fact everybody's so focused on short-termism and momentum means there's room for you to find good companies. And look, he's not doing anything weird. He's not going into strange corners of the market to find those good companies. His biggest holdings are Alphabet, Amazon, Visa, MasterCard, Bank of America. It's a very global focused portfolio. But his view, and I thought this was one of the more interesting things he said, is that often there's sort of diseconomies of scale when you get very big. That's been the historic trend, but he's arguing that that's in a way that's starting to evaporate a bit because these big businesses are able to find very profitable adjacencies. And the good example he gave was Visa and MasterCard. The rise of scams and cybersecurity concerns means they have developed and now sell services to protect institutions and customers from that. And that's become quite lucrative for them. So, I guess the summary for him is big is better. Find premium companies, as he called them, that can outlast inflation and aren't going to get caught in the meme stock mania.
Did he say, or do you know what he's investing in?
Yeah, so some of those things were some of those top stocks: Alphabet, Amazon, Visa, MasterCard. He's not in all the Magnificent Seven. He's conspicuously not in Nvidia and Tesla and a few of the others. But it's a pretty blue chip type of company. He likes healthcare, different parts of healthcare, like some industrials, but there is a heavy leaning to those big tech firms.
I note that he's as you were talking, I looked up the screens, and his share price is up 40% in 12 months.
Yeah, he's had a good run.
He's having a good run. That's
yeah,
right.
but I guess you would say so he should be. Most of those, the S&P 500's up something similar to that as well. So just buying the index would have got you something pretty close to that. So you'd want him to add a little bit of special sauce on top to get a bit more of a return, I guess.
Did he say anything about the budding Israel-Iran war?
He did not. No. He had a bit of a dig at populist governments without naming any, but no, he was silent on Israel-Iran. It might have been too soon, I guess. But yeah, I mean, it's interesting though. I am struck by how little impact there has been on markets. The usual sort of transmission effect for markets from Middle Eastern conflict is oil. It's moved a little bit, but I mean, even today we had some Saudi energy bigwig out saying oil's more likely to go to $50 than $100.
Well, and they're in a position to make that happen too.
Well, absolutely. Well, they've got no interest in making it go to 50, but they're clearly worried about it. I mean, this is the thing. The what's happening on the ground in Lebanon and Palestine and Israel is just awful, and you feel so much for the ordinary people trying to go about their daily lives. But the what we haven't seen is any impact on the flow of oil around the world, which is the main concern. A lot of that comes down to this deal that Iran and Saudi Arabia did back in 2023, and that's meant that unlike in previous conflicts where we've seen oil infrastructure attacked, particularly Saudi oil infrastructure attacked, we just haven't seen that this time.
Yeah, and I guess the point is the markets are betting that won't happen.
Yeah,
otherwise,
exactly
they'd be pushing oil up higher than that. So they're obviously betting that Israel doesn't really attack Iran in that kind of way, right?
It's a clear bet that nobody, everyone's scared of this sort of greater regional conflict, but the markets are betting that no one's really got much appetite for it.
Well, that's right. But the question now is, what does Israel do? Because Netanyahu has promised retaliation, but the question is, what sort of retaliation? Because they clearly would be in a position to really damage Iran's infrastructure.
Yes,
if they wanted to.
If they wanted to, yes. But how big do they want to make this fight? I think is the question. So that's what everyone's trying to figure out. But markets are giving you a pretty clear signal on what they think.
That's right. And you and I in the Money Cafe really have no idea.
Exactly, yes.
What's going to happen.
We're way over our skis here, Alan. That's true. It's true.
Well, I think you've got some interesting thoughts on Virgin and Qatar. What's going on there? So is that deal going to get approved?
I think so. I think I'm not sure how FIRB would knock back Qatar's investment. Yes, it is. Yes, Qatar Airways is a government-backed business, but Virgin has had government-backed owners before, but before it went into administration, it had several government-backed airlines as stakeholders, and it's currently owned by a big US private equity firm. So I'm not sure what grounds FIRB would have to knock this back. I don't see that there's a whole lot of interest from the government to come over the top of FIRB and knock this back, partly because the government's been talking this big game on improving airline competition for 12 months now. And this deal improves airline competition. So how does the government then knock it back? I think Qatar and Virgin and Bain Capital, the private equity firm that owns Virgin, have wedged the government, and they've probably wedged Qantas a bit as well. I mean, Qantas is making some noises about the arrangements that Qatar and Virgin will operate under to get back to international flying. But, I don't think Qantas's political capital is quite what it was. So I expect, I think this deal gets done. I think Virgin becomes a stronger competitor both internationally but also domestically, because being able to offer international network to domestic customers is important. And I think the rest of us get cheaper flights to Europe in the next few years. So, I think it gets done. I think it's probably a bit of a win for the travelling punter.
I see Qantas share price is down 6% or something in a couple of days. So do you think there's more selling of Qantas to come if it goes ahead?
I'm not sure. It is down 6% in a couple of days, but it's worth noting it was up 30% in 6 months to an all-time high, hit an all-time high last Thursday. So, is this a little bit of just a touch of air being let out of the tyres? Maybe. It doesn't make Qantas's life any easier, that's for sure. But by the same token, there's already lots of competition in the international business. The profit engine for Qantas is its domestic business. Yes, this makes Virgin a bit more competitive, but Qantas is still pretty dominant. If I'm a Qantas shareholder, I'm not petrified about this yet. That's for sure.
And just before we move on to questions, another interesting topic that's come up lately is the Reserve Bank was very upset with RBC because they got a private briefing, and then RBC went and talked about it.
Well, somebody at the private briefing went and talked about it. Probably one of RBC's clients, it appears. I don't know, Alan.
Why do they do private briefings?
Well, I'm a bit torn on this. I think we want the RBA to be out there in the market, talking to people, taking the pulse of what traders and investors are thinking, just as we want them, and they do. We want them to be talking to groups that work with socially disadvantaged people about the impact of higher interest rates. So we don't want. I think the great criticism of the RBA is at times they can be sort of stuck in this ivory tower in Martin Place. So we want them out and about, don't we? But I think the problem here is the rules of engagement on these briefings aren't really clear to me. Who gets them? How do they run? What questions can be asked? Who can attend? What are the rules about discussing what's being talked about inside these briefings? I mean, in some ways, who cares if there's a leak? The RBA shouldn't be telling the people at RBC, clients of RBC, anything that they wouldn't want to tell the rest of the world. So what does it matter if there's a leak?
So why were they upset?
Well, I guess because they see these things as a bit of a privilege or I don't know, a bit of
but that does raise the issue. If they were upset, then they must have told them something that they haven't said publicly, right?
So it's weird. I mean, people who have been to these briefings tell me that, no, you don't really get – the RBA doesn't tell you anything that they haven't said already. So it is a good question. Why were they upset about this? I don't know.
It's not like PwC getting private briefings on tax policy and then using them to enrich their clients.
No.
It's not quite.
So, the RBA's got a tough one, Alan. Do they just go, nah, we're not doing these anymore? We're out there talking enough, and then do they run the risk of sort of ivory tower criticism?
No, but anyway, what needs to happen in these, it seems to me, and the way you're explaining it, is that it's the RBA who gets briefed, right?
Yes.
That's what should be going on. If they've got their business liaison process,
yes, which
is well established and quite systematic, where they go and talk to businesses everywhere. Well, this is surely just talking to some markets people should be just part of that.
Yeah. But it's got to be a two-way conversation, doesn't it, Alan?
No, why should it? No, but if they're not going to say anything to these people that's not on the public record, then RBC or whoever it is, Morgan Stanley, they can read Michelle Bullock's speech and find out everything they need to know.
Oh, it sounds okay in theory, but how do you do that in practice when you're sitting there over a chicken and egg sandwich or whatever it is? The RBA is pumping RBC for information. You don't think there'll be a question coming back? So, what do you think about this, Ms. Bullock?
Well, the answer is read my latest speech.
Yeah. Anyway, look, I think that there's probably a middle ground to be found with a bit more disclosure and a bit more, some set rules around all this.
Fair enough. Before we move to questions, there's a quick word from our sponsor.
Looking to level up your investing game? Join InvestSMART's Investor Bootcamp and master the basics of investing, develop smarter money habits, and learn how to build lasting wealth. You can go at your own pace over 3 months with optional live weekly webinars to reinforce your learning. Usually priced at $99, Money Cafe listeners can save $40 with the code MONEY40. Head to www.investsmart.com.au/bootcamp and use the code MONEY40 and save $40.
Okay, thanks for that. Now, do you reckon, can I start with Elliot's question saying, will James Thomson apologise for his unrelenting support of the Coles and Woolies now that they've been taken to court by the ACCC for price gouging? Will he accept that the duopoly is clearly abusing their market power? Will he admit that his fervent defence of the grocery stores was misguided?
Jonathan also asks, it's a good thing that the ACCC listens to TikTokers and not James. Otherwise, the supermarkets ripping us off would continue to go on without any real recourse. Now, I did say on the podcast last week, as I'm sure you listened to, Alan, that this was a terrible look, what the ACCC is alleging, where the supermarkets have increased prices for a period of 3 or 4 weeks to reduce them in a relatively to reduce them to a price above where they previously sat for a longer period. I say again, this is a terrible look. It fails the pub test. Can they get away with it legally? That's likely to be tested. But actually, I don't think this will get to court because the Coles and Woolworths should take their medicine, acknowledge that they've done the wrong thing, and accept the settlement or reach an agreement with the ACCC and as I say, take their medicine, because they do not want to go to court and have this dirty laundry aired in the court. But
James, the question is, does it change your view about about those two Coles and Woolies, about how they behave? Because, I mean, I must confess that it did change my view a bit. I mean, I was more or less on your side about them. That, their margins were too great. They were not really gouging everybody, but now it looks like they have been, really.
Yeah, I think it does change my view. I think it's underhand or looks pretty underhand. And again, we need some better rules around this. Is it reasonable to hold a price at an elevated level for 3 or 4 weeks, or should a discount be from a price that's held at a level for, 3 or 4 months? That seems much more reasonable to me. So some sort of increase. Yes, it has changed my view. I think this is a poor look, and I think more transparency around these pricing practices is needed and warranted. You can hear the but coming though, can't you, Alan? But
what's the but?
The but is, what is the right level of price increase? Does Elliot and Jonathan have an idea of who should set how much prices should increase by or be discounted by? I mean, this is is this price gouging? It's a crappy look for sure.
No, but it's
I'm not sure.
This particular practice of theirs, it seems to me, is manipulation, right? Clearly, artificial manipulation of prices. They're whacking them up and then advertising that they've been cut. So,
yeah. But I think my original point was, who is to say, who's the arbiter of how big a supermarket's margin should be?
Yeah, no.
Is it unreasonable? So I don't think I'm sort of moving away from that point.
Yeah, fair enough.
And I just I think this is the question. I never want prices of anything to go up. That'd be, I'd rather we still paying $2 a litre for milk or $1 a litre for milk. Sorry, that'd be great. But
yes.
Sort of things change. So who decides how much should things change? Is it, should we have government mandated price controls? Don't know.
Well, we have them. We have those on some things.
Yeah, some things.
Electricity and gas, for example.
Yeah. So look, I take your point, Elliot and Jonathan, but I don't think it's as black and white as you think it is.
Okay, your turn.
Marek says, I'm a keen advocate for broad-based index tracking ETFs. However, I've read that those funds, such as Vanguard, have significant influence with regard to voting due to being the largest owner of shares. Indeed, CBA's largest shareholder is Vanguard. Do these funds have more clout and ultimately influence than others when it comes to voting on matters? And more importantly, should we be concerned?
That's interesting, isn't it?
Yes, but wrong.
Go
I mean,
on.
this is a common misconception that Vanguard, BlackRock, and State Street. I mean, even Andrew Lee, who's a very smart man, came out and said we need to be concerned about the biggest three shareholders in Australia are Vanguard, BlackRock, and State Street. No, they're not. They are not. They are the biggest operators of index funds, and firms like Vanguard are increasingly trying to pass on. They do not vote those shares themselves, and they are increasingly trying to pass on those votes, or pass those votes that they do control, back to the beneficial owner. So,
but that's not going to work, is it? That's not.
Well, no, they're rolling out these programs in the US, and they've started in Australia. I mean, why can't it work?
Well, how does it work in the US?
They say they go back to the beneficial owner. You've got X number of units in this ETF, so that gives you control of X number of votes in this company's
in 200 companies.
Yeah,
right.
So, but the idea that these firms are rolling around the streets of Collins Street and Martin Place in Sydney, swinging around their clout, it's just wrong. And we, it's a shame that this sort of myth gets perpetuated, because
but
it's not how things work.
But who's the beneficial owner of the shares?
Institutions.
The institution is, right? Vanguard is the beneficial owner of the shares, right?
Yeah, sorry, the actual owner of the votes.
The shares are owned by Vanguard, so it is their vote. They'd need to set up a separate system to pass the vote on to, or to allow its clients to vote the shares, right?
Yes, but they are not voting on these matters themselves.
So really, what's happening is no one's voting those shares.
Yeah, mainly.
Yeah, which gives everyone else who actually is a voting owner much more say, I guess.
Yeah. But it does. But I mean, this idea that these sort of there's three large empires exercising their clout, it's not right.
Yeah, sitting in their offices, tapping their ends of their fingers together.
Yeah. Muttering under their breath about Matt Common or whatever it is.
Luke says negative gearing isn't all about offsetting the costs of paying interest on a loan for investment property. You also get to claim the cost of improving the property as a tax deduction, don't you? Therefore, could it be argued that negative gearing is a good thing for upgrading or improving existing housing stock, resulting in better quality rental accommodation? Well, yes, you could make that argument, but I mean, because the negative gearing is that you can offset any losses, right? So it's an overall number of loss that you get to apply as a tax deduction, including included in the loss is any costs that you've had, including depreciation, which isn't much, but it's there. Depreciation, repairs and maintenance, and importantly, the cost of servicing your loan. So those are the things that go against as a cost, and then your income is the rent. And if the costs are higher than the rent, you get to deduct the difference from your other income.
Yeah,
which
I mean, Luke's point is right in a way, isn't it? That negative gearing is about encouraging investment in rental stock. That's the idea of it.
Well, sort of. I mean, the problem is that it kind of is about encouraging losses on investment. I mean, there aren't too many investments around where where you're kind of encouraged by the tax system to have a loss.
Yeah, true.
I mean,
fair point.
I mean, and the whole thing is that people invest in negatively geared property because they think they'll get a capital gain at the end that outweighs their tax deductible losses.
Yeah,
that have been, if they're on the top marginal rate, their losses as they've gone along have been more or less halved, and then the capital gains tax is halved. So God.
Yeah. No, fair enough. Richard asks, a couple of episodes ago, you had a person ask about worthless shares in a company that had been delisted from the ASX. I've got the same problem. The ATO states that only a letter from an administrator or liquidator can make a share officially worthless and as such a capital loss. But Richard has come across a company called Invest to Gain, using a website called delisted.com.au that will take my worthless shares and supposedly issue me with a letter of disposal. What do you know about this company? Is it legit? Well, it is legit. And I should say I'm not here to comment on the legitimacy of InvestorGain at all, or the quality of their services, or anything like that. But it does have an AFSL and all the official registrations. I had a quick look at the product disclosure statement around what they do around worthless shares, Alan. They basically buy your parcel of shares for a $1 consideration. And for that, you pay them a fee. I think, from what I read, the starting fee was about $150. So you can get you can get your worthless shares to claim as a capital loss, but you will pay a fee for that. And
they're a business; they've got to make money, I guess.
Yeah, that's right. And there's only a certain. There's a list of delisted companies or companies that they will buy shares in. But look, as I say, don't know much about it, but I had a very quick look at the website. They do have a product disclosure statement. They do have an AFSL. So, there's a bit more research you can do to understand their process.
And the website is delisted.com.au in case anyone else is interested. Ian in Bangalore has got a question later on about Redflow, which is in insolvency. Is Redflow finished or what?
I don't know about that actually, Alan. I think Redflow. I think Ian is wondering if he's going to get to the status of delisted.com.
Yeah, maybe.
But yeah, it's
maybe if he's keen on getting the tax loss, maybe he can persuade delisted.com to take his Redflow shares off him.
Yeah.
Anyway.
Your turn.
Scott says the ever-shrinking ASX is commonly mentioned. I'm curious why there isn't more effort from Big Super to maintain this type of market. My understanding is most hold reasonable portions of Australian shares as an investment option and in the long term require a market like the ASX to function properly. Do you think superannuation funds should be playing a bigger role in promoting to grow the ASX? Well, you're right in theory.
Yeah, I think the super funds would like to see or want to see a thriving ASX. They definitely want to see more companies come to the public market, so they've got an opportunity to look at them and invest at them. And they're, if a company floats, the first port of call for the investment banks is definitely the super funds. But the super funds are hamstrung, Alan. I mean, this is a common thing we hear. Why don't the super funds do something about this? The super funds have got, under law, one overarching duty, and that's to improve the financial returns of their members. So you might say that investing in a bunch of IPOs, which are generally riskier companies, or at least companies that are at the riskier end of their life, is counter to that one duty that they've got. So I think we just got to be careful saying, why don't the super funds do this or do that or do this? Yes, they've got this big pool of money, but they're pretty hamstrung with what they can do with it in many ways.
Yeah, I suppose Scott's suggesting the super funds start investing in IPOs not just because they think there'll be a good return from them, but because they want to see the ASX continue on. So, maybe you're right. Maybe what you're saying is no, they should not do that. They have to make a decision based on their view about the investment.
Yeah. Tim from New Zealand's got a good question. He says, a big well done to Effie for stepping in and steering the ship with when Alan was gone. Here. Alan, a few episodes ago, I think you mentioned bad investment advice. And it got me thinking about, my dad said to me when I first jumped into the share market, a profit is a profit is a profit. He would always cry and still does. That mantra has stuck with me. Any profit is a good thing, no matter how big or small. It puts my investing into context. What am I doing this for? How much money do I want to make? What am I buying? In other words, have goals no matter the size or shape. If you could give one piece of investing advice, information, what would it be? Keen to hear your response. That's a good question, Alan.
What's your one line?
Oh, don't put it back on me.
Oh, okay.
People want to hear from the guru.
Oh, I'm certainly not an investment guru. I've been kicking around a long time. I guess that's about all. I'm certainly no Chris Mackay.
I don't know if I've got a bit of advice, but the information I reckon, Alan, is understand how tolerant you are of risk. You know, some people are happy to take lots of risk. Some people get very anxious about taking not much risk. I think that is a really important thing, understanding how much risk you can live with, and how much, we get the odd question about, this house I've got this property investment, it's causing angst and anxiety in my family. Like, that's not what you don't want your investments to be causing you angst or anxiety. I think that is not a profit, that is a loss. So I think that's an important thing to think about. And the other thing that always strikes me, Alan, is don't ever do anything for tax purposes. I think that's the wrong reason to do something for.
Yeah, that's good. That's good advice. I mean, I must say, and I don't want to disagree with Tim's dad, because he's right that the profit is important, but it's not the only thing. And certainly, it's more about sustainable profits than just a 1 year's profit. So I presume Tim's dad is on board with that. That it's the profits have to be sustainable and have to be, not just based on some one-off short-term thing.
Yeah, no, well said. Do we want to finish with Serge's question, Alan? It's a good one.
Yeah, okay, right, good idea. Over the last month, says Serge, I've had a number of TDs, term deposits, mature, and have noticed how the rollover rates offered are on average lower by up to 0.6% for 12 months renewals. Couple this with zero movement in mortgage rates, and it points to the already large interest rate spread exploding over the next 6 to 12 months. Can we expect bank profits for the next half to reflect this consumer gouge? Bank shares outside of a highly priced CBA may be a good buy over the next 6 months before mortgage rates start to ease. Do we have a situation now whereby mortgage holders and savers are both being gouged? Also, all the banks have made their predictions when mortgage rates will drop. Okay, we'll do it. The banks don't have to wait for the Reserve Bank, so why don't they act independently? May I suggest it's a sham competition? Interesting.
Yeah, well, lest I be accused of being the defender of all price gouging on this podcast, but I do. Effie did make the point on last week that we are seeing a bit of movement on mortgage rates as well as term deposits. She pointed out that fixed rate mortgages have come down quite sharply, and there is an opportunity there. Again, this is completely general, but we're just making the point that there is an opportunity there to lock in fixed rates at a substantial discount to where the variable rates are. So we are seeing some movement surge. Not in the variable rate, that's true. Although even in the variable rate, the anecdotal evidence that I'm getting from talking to a lot of bankers is the competition under the surface in variable rates is getting extremely intense. We're seeing cashbacks come back again. That they've been out of the market for about 12 months or so, but there are some substantial cashbacks on offer, and discounting of variable rates is well and truly back. So yes, we're not seeing much movement in the advertised rates for variable rates. We are seeing a bit in fixed, and if you want a deal on the variable side, you will get it. So yes, TD, term deposit rates are coming down, as you'd expect, because bond yields have come down quite substantially. But there is a bit of movement in the mortgage market. You do have to do a bit more work to find it, though, Serge.
Yeah, and the other thing to bear in mind, Serge, is that the term deposits tend to be, as James just kind of alluded to, priced against the bond market rather than the cash rate. So even though the cash rate hasn't moved, bond rates have come down, whether it's 2, 3, 5 or 10 years. Those rates have come down in anticipation of cash rate cuts. But so that means that in general, and at this time, and it's also true that term deposits do tend to run ahead of the sort of what would you call the transactional deposit interest, the sort of at call interest, which is much more tied to the cash rate.
Yeah. I think just on Serge's point about the banks moving independently, I think the big test is going to be as the RBA starts cutting interest rates. Will one of the banks decide not to pass on the full cut in order to restore their margins a bit? So the RBA cuts 25 basis points or 0.25%. Does one of the big banks say, okay, we're going to pass on 15 basis points or 10 basis points rather than the full whack? I think that is a live question. But the problem for the bank that does that is it's going to end up in a hell of a lot of political pain. So, yeah.
I mean, it is possibly worth stating that the Reserve Bank does set the cash rate, which is the rate that banks pay each other overnight, and the Reserve Bank sets that by actually trading in that market by buying and selling. It doesn't actually issue a decree to anyone. It's not a price setting body in the sense that the ACCC might be, or a regulator might be, where they say the price for mortgages or the price for deposits is X. It's really just a guide, and the banks are able to do what they like.
Yeah. But there's a lot of political heat around going on your own path, I guess.
Yeah, sure. That's right. So the banks do tend to be guided, but they can, as you're saying, they can decide not to pass on a cash rate cut if they want to.
Yeah, indeed.
Well, that's it for this week. Thanks very much. I'll be back next week with Stephen Main. So send in your question and we'll answer it together. The question email is themoneycafe@eurekareport.com.au. Till then, I'm Alan Kohler, founder of Eureka Report, which is now part of InvestSMART.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review. See you next week.